Good morning. Today is Saturday, the 27th of January, and welcome to another episode of Two Grey Beards. So, what happened this week? Well, we certainly are having a very strong economy in the US, aren't we, Andy? Every number that comes out is a strongish number, from GDP to unemployment claims being low. There is really no sign of this economy moderating anytime soon, certainly not from the 2023 data that we keep on getting. We'll see if that gets revised in 2024. But 2023 certainly had a very strong ending, didn't it?
Sure did. We ended up printing 3.3% in real GDP. The inflation data was in line with expectations, which everyone pretty much knew because of the prior CPI and PPI data. But the real economy is doing strong. It was quite strong and above expectations. And indeed, the first estimate for 2024 Q1, which is, again, just uses the pretty hot retail sales data and durable goods data that we got that were also strong, has a 3% GDP rate from the GDP Now forecast. So there's just no sign that the real economy is slowing.
Yes, and it should not be therefore surprising that the equity market just keeps on rallying and that there is a rotation into equities and out of bonds, and it just keeps on continuing and continued last week a little bit. What we have next week is a very, very important week. We've covered what happened last week, and that basically the economy continued to be strong. All the data says that we are continuing to be strong and will continue to be so. Now it's the QRA and the FOMC, and what is going to happen there is going to be absolutely pivotal for both real rates and, more importantly, term premium. Do you want to talk about the QRA, Andy?
Yeah, sure. First, I want to just roll back in terms of what the year's been like so far in equities and the markets. By December 28th, the FOMC pivot and the seasonals and anything else that was driving markets peaked. Bond markets peaked on December 28th. Since then, the Russell is down. The S&P is up 2%, the Nasdaq's up 3%, and the FANG index is up 4%. And all of that rally, or a significant portion of that rally, has been in semiconductors and Microsoft. And that really only kicked off after Taiwan Semi reported a good outlook. So it'll be very important, and we see a lot of the earnings coming up. I don't consider the equity market having been particularly strong so far this year. It's really been extremely narrow and focused on what it should be, which is this continued AI semiconductor buy. So we'll see how long that lasts. And, NVIDIA's up, I think, 20% 20% since then. And AMD's up 25%. So it's really a chip-led story for January. The rest of the stock market sort of, had rallied back to its highs in August, or in July, but really hasn't followed through yet. So it'll also be interesting to see if this economic strength, which should be really pretty good for the Russell and the rest of the economy, shows up in the earnings. And so far, the earnings have been good. Anyway, so let's go to the QRA, and that's a two-phased discussion. We get data on Monday at 3 p.m. And that data will determine how much the government needs in financing for Q2. And so the estimates, Q2 is the government doesn't need much money from the markets seasonally in Q2 because it's getting its biggest slug of money from the taxpayers on that awful day of April 15th. And so the government doesn't need that much money. And so the headline expectation, the government doesn't need much money. My central case is around $330 billion. So we're going to get that headline. And if you don't have to follow it. If it means something, we'll email you. But, if it's in line, really not much market moving information will come. If it's out of line, there may be some market moving information. If it's low, that means the government doesn't need much money. The chances of the most important thing about the entire data is whether they increase the amount of coupons of long duration treasuries they are using to finance the deficit. That's the most important thing. The bills sort of fall out from that, the combination of the needs and the coupon decision. But the coupon decision is the one that has moved markets lately and will move markets this time. And a lower number may be a perception, may leave a perception for the market that the coupon number will not be increased, and that will cause assets to rally. So a lower number, assets will rally. A higher number means it's almost certain that the Treasury will have to increase coupons to finance. Now, they can still choose bills if the number's higher, but that seems very unlikely. So if the number's higher, you're going to get assets selling off. And I don't think that's a buyable sell off, but we'll see how far it goes. Mostly what's going to happen is they're going to wait till Wednesday morning at 8:30. And Wednesday morning at 8:30, they will announce how much coupon financing they're going to do. So they have the need and they have to choose how they finance it. They finance it with a combination of bills and coupons. And I think that they are leaning toward, given the market conditions, of extremely low term premium in bonds, not quite as low as it was in July when they made the last increase, but low, that they would likely increase coupons in one more step and then maintain that for the years forward as the amount of coupon issuance per quarter. And so there's two numbers. There's the net increase, and then there's the gross increase. And we'll show you another chart, which is now on the screen, about what our expectations are for coupon issuance. And so we're going to show the gross. And my central case is about $1.1 trillion of coupons. Now, that's not all going to market because 600 billion ish mature during the quarter. So there's going to be an amount that mature, an amount that's issued, and the net issuance will be what the market has to absorb, and that's about 500 billion would be my central case. Now that's an increase because this quarter, the one we're in, they're going to issue about 980 billion. So it's an increase of about 120 billion. And last summer, they increased the gross by 160 billion. And that caused a 10% sell off in equities and in bonds. So, anyway, those are the numbers. Now, if they're higher than 1.1 trillion, sorry, geez, it's a huge number, 1.1 trillion, that would be more bearish assets than my number. The other number is that they don't change the issuance and we get a number like 980 billion of gross issuance. And in that case, the market likely rallies. And so there's a bunch of complicating factors in this particular quarterly refunding announcement. In particular, for whatever reason, and there's not a lot of good reason for it, the treasuries may decide to enact a different reporting format, which will cause all of us that follow these numbers to go scurrying to try to figure out what it means. I'm prepared. They gave us a display of what the new format will be. If they institute it and don't use the old format, again, it's just going to be a bit of a mess, but we'll figure it out. And again, send through emails our synthesis of that. That's a complication. The other complication is the government intends to do a bond buyback program. And we don't have time to go through that in detail, but we will in future episodes. We think it's fairly neutral to bond supply and demand and healthy and saves the taxpayer some money and gives the Treasury some flexibility, but isn't QE. Nonetheless, the communication of that information, if they were to announce that the buyback was going to commence, which I think is about a 50-50 shot, in Q2, it's going to complicate it's not going to change the net financing, but it may change the gross amount of bonds they issue because they need new financing to fund the buyback. So once again, two fairly complicated things on what is already a fairly complicated bit of information. We'll synthesize it for you and send out an email. So then the question is, what are the reactions going to be to a low coupon issuance at 8:30 on Wednesday and a high coupon issuance? What do you think, Nick?
Well, I think it's going to be pretty simple. I think a high coupon issuance basically steepens the curve and vice versa. So I don't think there's really all that much to think about. The interesting question will be whether the FOMC presser then tries to dampen down whatever the market reaction was to the 8:30 announcement from the QRA, i.e., if they're playing a tag team, good cop, bad cop. Who can tell? But in any case, I think that the Fed is going to stick to its knitting. The FOMC is possibly going to push back against the March perception of an easing, but I certainly don't think they're going to push back against the perception that they will do 75 basis points at least during the course of 2024 and the 100 they have penciled in for 2025. So I think those dot plots, although they're not producing new dot plots, will remain in the market's mind. And it's a question really of the shape of the yield curve resulting from what they say. It is entirely possible that they will try to dampen the reaction if it's particularly in terms of the longer end of the curve. And I agree with you. If they don't seize this opportunity to increase coupons while the term premium is negative, then they're probably doing the United States a disservice. They should do it. They should increase it, but it's an election year. Politics certainly could play its part. We're not saying it will, but that's why we think it's wise to wait for the announcement and see what it is and react afterwards, while, like we do, have in place optionality in our positions. And I will go through the positions later on. And I think we are particularly well positioned, both in bonds and in equities, to be able to react to the news as opposed to guess what the news is going to be.
Yeah, I mean, that's the huge message here. This is complicated data. It's got an FOMC right in the midst of it and all this earnings noise. And we have leanings, like both Nick and I feel like assets have moved a lot, bonds have moved a lot, stocks have moved a lot. And we have positions in our alpha accounts, and we've positioned you in the two gray beards portfolio with optionality so that we don't have to guess particularly. We can have leanings, and our leanings are, the leanings are that they're going to issue more coupons, and that's going to be a bearish pulse. But let's find out. Let's find out what they do. One other question, Nick. You and I have been following this quarterly refunding announcement probably all of our careers.
Yeah.
And, from a macro standpoint, I started identifying it as being an important impact on the transmission of both QE and QT in 2020. But I don't know, maybe it's some of our appearances on podcasts, on television, and so on, or the market reactions. But it seems like this is going to be being very well focused on versus any QRA I've ever seen in my career. What do you think the implication is?
Well,
Do you agree?
it's difficult to say, but certainly I agree with you. I've never seen more press about it, whether it's on social media or the Wall Street Journal or on TV. Everyone is awaiting this QRA with bated breath, and everyone's going to have their own interpretations of it. What the implication is probably that the market is better prepared for an increase in coupons than otherwise would be. If you have a look at what the yield curve has done over the course of the past couple of weeks, you will see that it's steepened, and therefore people have kept their optionality at the short end and decreased their positions at the long end just in case the QRA is worse or there are more coupons than people fear. Therefore, I think the overall reaction is going to be slightly less severe than you might expect because people are probably already positioned for it. But
Right.
again, no need to guess. We will see and we will advise accordingly.
Right. And just to put some scale on that, the 30-year bond yield is 4.37. Going into the big moves in July, 30-year bond yield was 4%. It rapidly moved over the course of 2 months to 5%. My view is that a more coupon QRA is not going to move us to 5% in any rapid pace. 4.75, maybe, but 5%, markets are more prepared for the outcome.
Yes. What will move, and you're absolutely right, is the term premium. The term premium will go back to positive. Now, whether it's going to be 10 basis points, 20 basis points, who knows? But that should have a dampening effect on equities, and we're positioned for it. So let's just wait and react accordingly as we see the numbers.
Sounds great.
Thank you very much indeed. I'll now go through the positioning and we will send you an email if we need to do anything at all Monday or Wednesday. Bye-bye. As we advised you on Monday, we sold all our equities and replaced them with call options, and these are the call options: the 378 call in DIA, the 483 call in SPY, and the 422 call in QQQ, all expiring on February 16th. What I've done here, and I know this isn't perfectly accurate, but I just wanted to give you an idea of what the allocations would be if we were to be exercised on those options. We would be at roughly 45% in equities and roughly at 50%. Now, we would need to sell the cash in order to meet those allocations. That's why it's not exactly 100%. But so I just wanted you to have an idea of what the allocation would be if we were exercised on those. I think the optionality that they provide is excellent over the QRA and FOMC, because if term premia do expand significantly, then I'm quite sure that all these equities will fall substantially, probably by over 5%, and we will save ourselves some money. In any case, just have a look at the order entry here for next week. Naturally, no orders are entered. We will send you an email either on Monday and or on Wednesday, or possibly both days, to make sure that you understand the implications of the QRA and of the FOMC, and that you are ready to react, and we will tell you exactly what we are doing, if anything, to adjust the portfolio according to what the actual news is, as opposed to what we might guess it would be. All the broker statements are here, so you can see exactly what the positions are. And just for good order's sake, we were short a couple of options in HGY, and those expired worthless yesterday at 4 o'clock, and therefore we have no position there. So these are the correct positions that we have, but in any case, have a look at broker statement and they're all there. Thank you very much indeed. It promises to be a very exciting week, and we look forward to sending you an email accordingly.